Guys, these are 5 stocks that have potential market-beating returns over the next 10 years, and I own 4 of them. Stock number 1, American Express. So guys, let's look at this. In the last 5 years, American Express is up 120%. Last 10 years, 189%. The last year, 41%. Big time gains, 6 months, 53%. American Express is a moat. Why do I say that? Guys, it's all about the exclusivity, and American Express really tries to cater to the higher end exclusive market of credit card users, and that's what's wonderful. Now, what are the competitors out there? Visa, MasterCard. Let's look at this. Bottom line profit margin. Last year, 13.9%. Last 5 years, 14.34%. Now, here's what's interesting about American Express. Their free cash flow in the last year, $17 billion. In the last 5 years, $13 billion. Look at their net income, 8.4 versus 6.8 billion. So free cash flow a lot higher than their net income, which I love. So I would value this business based on the free cash flow. Now let's take a look at their income by year. Look at this growth, guys. This is going back to 2015, 32.7, 36.7, 36.9, 40 billion, 43, 36, COVID year, 43, 52, 60. Big ramp up. Now remember, look at these growth rates. When you look at last year to this year, this is a big difference in terms of growth. This is a big jump in growth rate. 8 billion on 52 billion is about 16 or 17% growth. That's big money. Do not expect that to continue on forever, because look at the past over here. From 32 billion to 37 billion, that's about 15 to 16%. But then next year, about even, 0% growth. Then about 11% growth from 36.9 to 40.3, and about 8% growth from 40.3 to 43.63. So remember, you're looking at long-term. That's why we look at 10-year growth rates. You don't know from year to year what that growth rate's going to be. We've seen as low as even, we've seen as high as 17, 18%. That is what I'm trying to get at. Don't get caught up in the 1-year growth rate. Look at 10 years. Make sure that you sit there and say, hey, over the next 10 years, they're probably going to grow at X%. Some years will be better, some years will be worse. Focus on the long run. So guys, let's check out the net income for the company over the last 10 years. You've got 5.1, 5.3, 2.75, 7, 6.7, 3.14, 8, 7.5, 8.4. Do you notice something here? You've got growth, fall, growth, fall, fall, growth, fall, growth. But still an increase, 5.2 billion to 8.4 billion. That's a growth rate of roughly 60% even, 50 to 60%. And that's my point about looking at these numbers over a long haul. In the short run, it's going to go like this. But over the long haul, you want to look at the trend going up, and that's what you're buying. Okay, let's see what analysts are saying about this company, because we want to get some sort of idea of what the guidance is here. This is the earnings per share. They're expected to make $12.53 this year and $14.68 in a few years. I'm actually surprised at this not much growth rate here. You've got 10%, 15.5%, a drop of 3.4%, and an increase of 5%. Now keep in mind here, 32 analysts in year 1, only 2 analysts covering the second and third year. So just keep that in mind, as well as keeping in mind their bias going into this. And of course, we look at the revenue growth. We have 8.8%, 8.5%, 8%, and flat, taking the revenue to $66.7 billion up to $78 billion. So again, long-term growth rate is what you care about more here. So let's go see what this company is worth to us in our stock analyzer tool. I'm going to pull up the last time I did it, March 11th of this year. Now, again, I actually did a 20-year analysis. Let me just do a 10-year analysis here, because we want to look at this company over the next 10 years. First line here, revenue growth rate. This shows our 10-year revenue growth rate of 6.8% per year, our 5-year growth rate at 8.5%, and our 1 year at 14.8%. So you see an increase, but again, as companies get bigger and bigger and bigger, I don't think it's realistic to expect faster and faster growth rates. Is it possible? Absolutely. But part of your margin of safety and part of your ability to be a little bit more conservative is don't make those assumptions. So I assumed 4 on the low side, 7 in the middle, 10 on the high side. okay? And for the next 4 companies, I'm doing this a little bit more thorough so the next 4 companies can be a little bit more efficient, okay? Now, profit margin, 14.4% 10 years ago, 14.3% over the last 5 years, and 13.9% over the last year. So pretty consistent here. So I did 12, 14, and 16. Free cash flow, much higher. 26.8% over the last 10 years, 27.7% in the last 5, and 28.2% this year. So guys, I actually went a little more conservative on the free cash flow rate. I'm actually going to change that right now. I'm going to change this from 22, 24, 26 to 24, 26, and 28. Because I look at this going, yeah, they're going to generate this free cash flow. And remember, the free cash flow is significantly higher than their earnings. PE. What PE and what price to free cash flow are you going to assign to this company 10 years from now? It's not an average over the next 10 years. It's what is it 10 years from now? We obviously don't know, but every investor has to make these assumptions, okay? I put in 18, 21, and 24. I could 100% understand the argument for a higher PE and a higher price of free cash flow. You will not hear me argue. I mean, I look at it going, if you said to me right now, Paul, what's the number 1 credit card brand in the world? It's American Express. Without even flinching, I would say that. So I look at this saying, should this go higher? Guys, I'm actually going to go a little bit higher. I'm going to go with 20, 23, and 26. Because again, you got to sit there and say, you got to pay a premium for a good brand. You have to. And I love the fact that their free cash flow is so much greater. Okay. And then finally, for our desired return, remember, I'm trying to do a market return right now with no margin of safety. That's why I put 9% in. But you've got to remember, Seth Klarman says we need margin of safety for 3 reasons. 1, valuation is an imprecise art. It's fluctuating. We don't know what's going on with it. 2, the future is unknown. We have no idea what's going to happen in the future. And 3, guys, we're human. We make mistakes. I make mistakes all the time. The more margin of safety you have, the more likely you are to account for those mistakes. Now, at 9%, it's basically the market. So if you want a margin of safety, you got to go higher than 9%. But right now, based on a market return, I'm going to hit the analyze button. Guys, I got to question what I'm missing here. Because I look at these prices, 196 to 400 on the low side, 503 to 880 on the high side, 315 to 589 on the low side. The question is, why isn't my watch list at 140? Well, I have my sunk cost bias of the fact that I bought it around 140 to 145 before. All right. Stock number 2 that I also own, Disney. Now, Disney has Nelson Peltz going, trying to get board seats and trying to get other investors in the company on the board to turn things around. My thesis behind Disney is purely a profit margin one, and let me show you exactly what I mean by that. First off, though, look at this. In the last 6 months, Disney is up 49%. In the last 5 years, only 9.8%. So that means in the last 6 months, their return has been 5 times greater than the last 5 years. And in the last 10 years, the total return from just a price perspective, not including dividends, 50% versus 63%. So 80% of their growth in the last 10 years has occurred in the last 6 months. Okay. Now let's go to the income statement so I can show you my thesis behind this. Now, 2015, we had $54 billion in revenue, then 55, then 55.7, then 60, then 75. Then during COVID, it fell to 60. They shut down all the parks, so I understand that. But then it jumped up to 73, 84, and 89. Again, look at the revenue growth rates. Basically 2%, then 1%, then 10%. Nope, not even. 8%. Then 60 to 75 is 25%. 75 to 60 was minus 20%. 60 to 73, another plus 20%. 73 to 84, another 15% growth. 84 to 89, 5% growth. So again, big fluctuations in revenue growth. And a lot of this growth rate has been driven by Disney Plus. 120, 130 million people using the thing at $5, $6 a month. It adds up there. They've been doing a good job of this. But let's look at the net income here. Well, actually, let's look at this. Let's look at the operating income. So for a company like Disney, I want to start focusing on operating income. Why operating income? And I'm going to start doing that in the future more and more. Operating income is going to show, hey, don't take away the debt, take away all these other income and expenses. How's the business fundamentally doing? So if we go back to history here, operating income is right under total operating expenses. We've got 14 billion, 14 billion, 14 billion, 14 and a half, 11.25, 1.2, 5.6, 6.5, 9.94. It's not very good. This is not very good at all, guys. I do not like this. This makes it look like, oh my gosh, this is terrible. We have a decline over the last 10 years. Go look at the net income. Same thing has happened here. 9 billion 7 or 8 years ago, 3 billion now. But look at that. That's my big key here is the profit margin. Profit margin historically was 10 to 15%, and they're now operating at 3.5%, 4% profit margin. So my hope is that it ends up getting back to this point at some point. If that's the case, we could do very well. Now, I'm going to pull up analyst estimates to show you if analysts agree with me or not. Analysts this year are expecting $4.35 earnings per share. That's a 17.5% increase from last year. And from here on out, look at this growth rate. 21%, 18%, 13, 28%, doubling to $8.98 per share. Now this $9 per share, guys, I'm gonna do a little math for you here. Pay attention. $9 per share times 1.8 billion shares outstanding. I went to the income statement, scrolled all the way to the bottom. It showed me the number of shares outstanding. 9 times 1.8 equals, so 20 times 9 would be 180 minus 10% is 100. So $16.2 billion in profit. $16.2 billion in profit. Now, let's scroll to the bottom. On $109 billion in revenue. What's that margin? 15%. So analysts are trying to say, hey, they can really grow their profit margin up higher, back to more normal levels. That gets it back to 15% versus 3.5% and 4%. Now let's see what that does into the stock analyzer tool to determine what is the value of this thing. So I'm going to pull up Disney here. Revenue growth, I did 3, 5, and 7%. Profit margin, 6, 12, and 18. Same with free cash flow. So I didn't go all the way to 15%. I still sat there and said, by the way, if you do 10% in here, I get it. If you do 9%, I get it. Being a little more cautious. PE, I did 18, 21, and 24. And same with price of free cash flow. And again, the 9%, no margin of safety return. I hit the analyze button. And guys, I have a price here today. Low price of 50, high price of 250, middle price of 128. So I feel like, hey, it's not bad here, okay? Now, guys, I want to show you something about Disney that really matters a lot to me. This is the 5-year chart, okay? In the last 3.5, 4 years, you've seen nothing. And they got rid of their dividend for a large chunk of it. So you might sit there owning this company going, where the heck is this thing going? And if you're the kind of investor who only buys based on the stock price going up or down, that's a speculator. That's no way to be. But we've all been there. And this emotion of seeing such a great company give you no return can really weigh on you. Peter Lynch has a wonderful statement. Everyone has the brain power to make money in stocks, but not everyone has the emotional side to make money in stocks. What does that mean? Guys, we can all analyze a company. We can all love a company and say, I'm buying it because I love X. I love Disney. I take my family there every year. I love Tesla. I own one. My wife owns one. We love it. But in order to stay with the company when the news is bad, look at Tesla recently. Look at Disney right now. They're going through a battle. They've been part of the woke movement. People have hated them, etc. That's where it's hard. We're all going to make decisions based on fundamentals, but you're going to keep your stock and you're going to be successful and make money in it by waiting and being patient, okay? We've all been there with the emotional ups and downs of seeing a stock go down, seeing the news out there. But remember, news follows the stock price, not the other way around. What that means is as the stock price goes lower, the news is going to give reasons why that stock is going lower. As the stock goes higher, news is going to give the reason why, okay? Now, every person in the world, every investor, myself, you included, you can remember a time where you made an emotional decision about money and truly regretted it. And in hindsight, when the emotion was gone, you're like, what did I do there? We have all done it. I've done it so many times, it's ridiculous. Warren Buffett's even done it. And that's exactly why I spent millions of dollars creating this software in the community. I use this software every single day to make my fundamental and analytical decisions to purchase an investment. But the community is what I created in order for people to be able to go there and either have the emotional calm that I need to be able to navigate the ups and downs of the market, or get feedback on my ideas and see what other people think of them. There are thousands of people in here. And they're researching Disney. People have talked about Disney. People have talked about every company out there. You can, even if they haven't, they can offer an idea of what to look for. These thousands of investors in the community are either already in your position or have been at some point, and it can help you, calm you to remove as much emotion so you can stick to the fundamental decisions that make the most sense and will make you the most money. So if you're sick of making those emotional decisions that cost you money, like I have, join our community by clicking the link below and sign up for $7 for 7-day trial. Invest in yourself. And Warren Buffett always says the best investment you can make is in yourself. So click that link below. And after you join, tag me in the general chat and say hi. Stock number 3, and one that I do not own, is Google. Mo owns it, and I feel like an idiot for not owning it right now. But again, let's look at this. 5 years, 162% up. 6 months, only 16% up. That's not as great as I thought. 1 year, it's up almost 50% though. Okay? Amazing. Google owns the market for search, and they own YouTube. The top 2 search engines in the world are Google and YouTube. Another thing I want to show you guys here. Look at this market cap, $1.96 billion. This is if you bought every single share on the market and owned it fully. And this enterprise value, 1.96 trillion. Same as I think I said 1.96 billion. I meant $1.96 trillion. This means there's essentially no debt in the company. The cash wipes out the debt. And guys, that's super important for companies to be able to live longer lives, right? So I love the fact that these tech companies these days are keeping great balance sheets and realizing we don't need to have debt in order to do well. 56% gross margin, that's awesome. 24% profit margin. The gross margin here is before paying overhead costs and taxes, those kind of things. This profit margin is after all expenses. That is awesome. All right, let's go check up this income statement because it's incredible. And we're going to also look at the operating income. 75 to 90, 20% increase. 90 to 110, 20% increase. 110 to 136, 20% increase. 136 to 161. So that's 26. Guess what? A 20% increase. 161 to 182. Okay, that's more like 15%. And I'm estimating here 182 to 257. That's 70 billion on 182 billion. So 70 divided by 182 is about 25% growth. So this is a 25% increase from 2020 to 2021. What happened then? People started doing more on the internet. In 2021 to 22, about 25 billion, about 10% increase. And here, another about 9% increase. So they had a big stretch of 20% growth and then slowed to 9 or 10%. Does this mean it's going to zero? No, of course not, guys. But Google, as it gets larger, at $307 billion in revenue, you got to realize it's going to be harder to grow at large percentages. Now, how's their operating income doing? I think you'll be pleasantly surprised here. 19 billion to 23 billion, 20%. 23 to 28, 20%. 28 to 32, about 15 to 18%. 32 to 36, 10%. 36 to 41, about, what is that? About 15 to 18% again. 41 to 79 billion. That's almost 100%. That's like a 90% increase in operating income. They skyrocketed during COVID, guys. And the best part is, guys, we always warn people, when something skyrockets, be sure that's not some fluke. Make sure it's a fundamental reason. This would have scared me back in COVID, going, is this really going to be stable? Is this going to stay up this long? And look, it fell year over year, but right back up to 84. It went from 78.7 to 75 up to 84. So this shows this business is growing its operating income. That is awesome. Let's go see what the analysts are saying. Now, $7 per share in profit this year, growing, it's high 16.5% higher than last year, growing 15%, 16%, 16%, 23% to get to $13 per share. And what's that growth rate? That's huge. So remember, you need to pay more money for a high quality moat business. I think Google's that. And 2, for a fast growing business. They're growing their earnings per share very quickly. So it deserves a premium. So let's go to our stock analyzer tool and see what value we come up with for the googly moogly. Here's what I did for my 10-year growth rates. Revenue, 5, 8, and 11%. And I also want to show you guys another thing. Their return on invested capital is increasing. Over the last 10 years, it's 13.5%. Last 5 years, 15.4. Last year, 17. You want to pay more for companies with an increasing return on invested capital. That is awesome. Profit margin. I did 22, 24, and 26. Same with free cash flow. And for PE, I did 20, 23, and 26. Guys, I don't know on this one. This is an incredible company. It has YouTube, it has Google, the 2 top search engines in the world. What is the appropriate PE and price of free cash flow? This is why I want you using this software. I want you to put your numbers in here. I could literally see, if somebody said to me, Paul, I want to pay 25 times Google, I'd be like, yeah, I get it. If you want to own this company for a very long time, go for it. I can't blame you for that. I hit the analyze button. Values I get are 115 on the low side, 260 on the high, 173 in the middle. And the stock's currently at 156. Mo bought it like 135 or something. So good for Mo. And I'll probably regret not buying it. Guys, stock number 4, Rowe Price. Again, I own this company. They manage money. I love the fact that they do this. So look at the stock chart. We had an all-time high back in August of 2021 of $224 per share. And it's currently at $120 per share with a 52-week low, guys, of $87 per share. That's a big drop from August. So if you bought this up here and you're watching this video, remember, you can't do anything about where you bought it. You absolutely cannot. This is part of the emotional side of investing I talk about because this will weigh on you. Remember, when you buy a stock and it collapses, you feel gross. When you don't own the stock and it collapses, you feel opportunity. But what's the difference? It's just the fact that we owned it before. We've all been there where we see a stock we love that we own go down and we go, oh, but we see another stock that we didn't own fall. We're like, yeah, that's awesome. I can go buy shares. That's the part about the emotional side of investing I speak of. What matters to you, even if you bought at the very top right here, even if you bought right there and you still own the shares, you've got to decide, is the company a good buy at the current price or not? Is there a better opportunity for me out there? Don't worry about what you paid for it. And trust me when I say this, that's way harder to do than what I'm saying. But again, that's why the community is there. All right, let's go look at the income statement for Rowe. Now keep in mind, Rowe Price manages money. And in a bull market, their revenue is going to jump up a lot faster than others. And you'll see that here. 4.2 to 4.28 to 4.85, 5.37, 5.6, 6.2, 7.67, 6.5, 6.5. Now you might sit there and say, that's not a big jump. But this right here, guys, is a 50% increase for a company that's a pretty big money manager. They manage $1.5 trillion of assets. That's a lot of money. Now, I'm sure a lot of it has to do with like fixed fees, but a lot of it's driven by how much is under their management. So as the market goes up, this is a good way that if you believe in the future of the stock market to get in on a company that generates cash flow that way. So let's go see what the analysts think about this. Now, this is not this non-sexy part of the company. $7.6 per share this year, going to $8.12 in 4 years. That's not much growth, guys. That's not much growth at all. Now, I believe in that because I'm looking at going, I think the next 5 to 10 years in the market are going to be tough. So I'm okay with this. Earnings growth, look at this, actually down. 6.8 to 7 to 5.85, 5.85, 6.2. They're actually down, which I also probably agree with. But that's why I did my analysis on a 10-year number. 3, 5, and 7% growth rate, which I still think is actually a little aggressive, but we're fine with that. 26, 30, and 34 for profit margin. Their free cash flow is actually lower, which I don't really like a lot, but it's right here at 22, 26, and 30. And for PE, I went a little more conservative. I did 15, 17, and 19. There's a lot of money managers out there. Yes, the switching costs for Rowe Price are high, but I still want to be a little conservative, especially with the future and what it held. And I did my 9% desired return. Hit the analyze button for 10 years. Yeah, it looks pretty good. A low price of 98 to 115, a high price of 207 to 235, middle price of 144 to 166. So it's still there, but I'm going to tell you right now, I do believe this company's going to have a lot of volatility. I do believe that they're going to see new lows at some point here. Why? Because I look at it saying, as the market does crap over the next 10 years, I truly believe it's going to happen. I also think that these money managers are going to get beaten up. You have to look at it as an opportunity to buy more if you own the company and be ready for that. If not, Great. I mean, we could be in a new bull market. I don't believe that, but that's the case. That could be the case. Final company, company number 5, Generac, the generator maker. Love these guys. Stock's currently at 126. Look at this all-time high, $524. It got as low as $80 just 6 months ago. Guys, $80 divided by 526, 85% drop. Now, again, if you bought at 526, you're nauseous right now. If you didn't buy then, you're looking at this saying, oh, wow, this is a big drop. And I love looking at companies that have fallen big because it's a good way to say, hey, is it really falling big? So let's go take a look at Generac's income statement to look at this revenue growth. Let's look at this revenue growth. 1.3, 1.45, 1.68, 2 billion, 2.2, 2.5, 3.75, 4.6. Before last year, I was saying, well, this revenue growth was probably driven a lot by people putting a lot of money in their homes. And look, a drop in revenue here to 4 billion. So 4.5 billion down to 4 billion. Let's break it down a little bit more. Let's look at the quarterly growth year over year so we can see how it looks. January of 2023, 1.06 billion in revenue. January of 2022 was actually pretty even. It's actually up a little bit. That's surprising to me. That's actually surprising to me. So maybe things are stabilizing. I don't know. So operating income by year, 220, 200, 250, 360, 375, 480, 750, 567, 387. Big time drops here. So again, guys, I believe Generac's a great maker of generators. I like the company, but you've got to be ready for it to stabilize. I don't know when it's going to stabilize, but that's why we use our stock analyzer tool to decide what is the right price for us. Earnings estimates by analysts, $7.40 per share, which is 33% higher and growing. So even with declining revenues, even with declining revenues recently, they're expecting EPS growth, big time earnings per share from $7.50 to $12.50. That's what, 60%? 70% revenue growth, earnings per share growth over the next 4 years, and revenue growth. Actually, look at this. 8%, 10%, 10%, 7%, 7.5%. Again, don't take analysts. Analysts are going to be very optimistic and are going to love it. But let's go check out the stock analyzer tool. Guys, I think I've shown you here how incredible it is that companies can go up and down so drastically, and that really can weigh on your emotions. And that's why I stress how important the emotional aspect to investing is. 10-year analysis. I did 4, 6, and 8% revenue growth. And look at that, drop of 12% last year. But I did 4, 6, and 8%. Profit margin, I did 9.5, 10.5, 11.5, and same with the free cash flow. Because if you look right here, in the last 10 years, their profit margin and free cash flow have been very similar. So I'm okay keeping them the same, just to make it simple. PE, 15, 18, and 21, same thing here. It's not a really sexy high growth business. It's not really a sexy high ROIC business. So I went a little bit more conservative. But I did 9% desired return, hit the analyze button. And guys, remember, click the link below, sign up $7 for 7 days for the Everything Money community to help take control of your emotions in investing. And look at this, guys, a low price of 103, high price of 210, middle price of 148. Thank you very much for your time. If you want to see the other companies that I own, check out this next video on the 13 companies that I own in my portfolio.